So Matt's going to train you guys somewhat on ULs a little bit as soon as I wrap this up. But I haven't had a chance to get in front of you guys in a little bit, specifically regarding some new products or products that aren't necessarily ones that I've heard a lot of people in this organization talking about. So I wanted to put something in front of you guys that, in my opinion, is one of the better products that we have available. The company, in order to write this product, is called the Legacy Marketing Group. Just to kind of give you guys a little bit of a background. The product I'm talking to you about, and any products through Legacy that we have access to with ASB, means we are the only people that have access to these products. The Legacy Marketing Group specifically designed these products for ASB agents, and they write them on America's paper because they're a marketing company, not an insurance company. So in order to be able to write the things that I'm talking to you about, you have to get contracted with Legacy and America. Okay? Does that make sense? John can help you with all that stuff. What?
You're already contracted with America, or is half of it done?
You still have to get contracted with Legacy, and then you can let America.
They're two. Yeah, they're one. They go together. Okay. Have them both.
Okay. So this particular program, I'll tell you, there's really only two products that I think right now that Legacy's putting out that are worth talking about. I'm choosing to show you guys one of them. The two products are almost exactly the same. The only difference is the cost of owning the product, the rates on the product, and that's really about it. So I'm going to talk to you about the one today that does not have an asset fee. Okay, these are fixed index annuities. If any guys in this room have not been through Annuity 101, we'll hopefully do one of those real soon, maybe as early as next week if time allows. But I think this program is really cool. There's not a whole lot of bells and whistles to it, so there's not a whole lot to get tripped up on, and I think it's really pretty easy to be able to talk to your clients about. For those of you guys that have been writing a fair number of annuities, or for everybody that's been talking about the Athene Performance Elite 10 a fair amount, I want you guys to really pay attention to this product because, number one, everybody's aware that Athene just dropped their rates down some, right? So that product's not illustrating as strong as it once was, right? Obviously, we're in the business of making our clients happy and doing as much as we can for their money, so I want to give you guys a different alternative, okay? This product has no fee, okay? There is no fee on this product. On the version that I've been working with, it also has no bonus, all right? So the Classic Mark LT is the one that has no bonus. If you need a bonus for some reason, you can write the Classic Mark LT Plus. It's got a 3% bonus, all right? And just because South Carolina is weird, if you go on the Legacy site and you see something with a 4% bonus, that's for people that don't live in South Carolina. We have a 3% bonus, all right? So if you're going in and doing the e-app, you need to look for either the LT or the LT Plus, okay? The only difference between these two are the rates, all right? If you opt for the one that has the bonus, you're going to have lower rates, lower caps, lower participation rates. Go for the one without, you're going to have higher caps, higher participation rates, all right? So why would we want to do that? Well, I think the Athene product is still a great product. I'm having to make up surrender charges. 9% is kind of hard to beat. So 3% really doesn't come into the conversation. But if I'm moving money from somewhere that doesn't have any surrender charge, or doesn't have any back-end costs, I'm going to use the one without the bonus because I don't really give a rip about 3% if I can make you more money year after year, 10 years in a row, right? Does that make sense to everybody? Yeah. Well, I've given you guys all the rate sheet here. And you can tell me if you agree or disagree with me, but we have a one-year point-to-point S&P 500 cap, 4.5%. It's pretty strong if you're looking for a very basic, right? Monthly cap, 1.9, all right? That's going to come in right around 23% a year if we have a gangbusters kind of year. That's pretty silly. That's the highest monthly cap I've seen in quite a while. The one that I think is really, really cool, and I was talking to some people outside about this, if you look at the third one down, it's called the S&P 500 point-to-point inversion strategy. That means we're betting that the market's going to fail. And we can make up to 7% in a year if the market should go down 7% or more. Isn't that crazy? Anybody think that's cool? I think that's cool.
So you lose 3%, you make 3%. Like if they lose 3 in the S&P.
Now make whatever the market loses up to 7%. That's awesome.
How do you do that?
Just buying different options. So imagine that you've got that client. Any of you guys ever sat down in a house, and this was kind of a conversation I was having outside with folks. You ever have that client that really likes the idea of the fixed index annuity, but then they say, if the market fails, I'm not gonna make anything? I don't like that. I could stay in my CD and make 2%. Well, I would argue if you mix in the inversion strategy at 25 and 50% of the allocated dollars as a hedge against the market doing well compared to it doing poorly, they're going to make money in either scenario, right? Market up, they make money, market down, they make money. It's a pretty neat idea. So just something to think about. Excuse me, if you're looking at the way that these are illustrating, if you call Greg Haney and you ask him to put together an illustration for you, he's almost assuredly going to give you the fifth one down, the one-year Morgan Stanley Target Equity Balanced Index. And I'm not here to go into a lot of indexing strategies with you guys, so if you want information on that, call Greg or get on Legacy's website and pull that stuff up. But that one's illustrated really, really strongly. So, and even on the fixed rate, guys, we're at 2.4.
What does that illustrate at? Dave?
What is it illustrating
The
at?
10-year, yeah.
It's coming in a little north of 6. So again, like I said, it's looking very, very, very similar to the Athene Performance Elite 10, but I know that most of us that are riding the PE 10 are doing it with the liquidity rider. So we're charging somebody roughly 1% a year to have that product. Yes, they get a 9% bonus. This is allowing them to grow that money at almost the exact same pace with no fee, no bonus.
If you allocate to the inversion strategy, and let's say the market went up, does that net out of the occurrence of the positive allocations?
No, the market has to fail for that one to pay.
Okay.
But he's asking you to take away from your other.
I can't hear you.
He's asking if it would take away from your other gains if it was performed.
Well, the market's either gonna go up or gonna go down, right?
Yeah.
So whatever percentage you've allocated proportionately is what's gonna happen. That make sense? I mean, I don't know how to tell you, it's not gonna take away anything. It's either gonna pay you because the market failed, or it's gonna pay you if you win.
It's like an option, it goes in the money when it goes down only.
Right.
So 25% of the money, if you allocate 25% of that one allocation, that's what you would earn on if the market was down.
Correct.
25% of it.
There's a bunch of individual bets.
So instead of being at 0, you make money.
Correct.
But the one allocation is not gonna affect the other
Correct.
allocations.
Those allocations basically function independently of the others, 100%. So if you have an annual point-to-point betting on the S&P doing well, and it does, you get paid. If you're betting on the S&P doing poorly, and it does, you're gonna get paid.
I wanna throw something out at that, that's huge. Very few annuities have a bear market strategy. So we just hit the 10-year market. We've been up 10 straight years. So somebody says, well, I don't think the market's gonna go up anymore. Well, there's the product right there.
Turns out, I don't either. And guess what? I want you to get paid if it doesn't.
Put 100%.
Do 50 in that,
So-
and 25, and 25 in fixed.
Do you look at me?
I thought you were about to say something.
I am, I have a question.
Fire
So
away.
why would I not do 50 and 50? So when the market's up, I'm making, it's kind of worked itself out. Why would I not do that?
That was a suggestion that I was throwing out.
Great strategy. It's like a straddle.
Yeah, I mean, you're gonna win no matter what that way.
Let's get you signed up with American.
Watch
No, that's exactly what I'm talking about.
Did you already say that? I'm a little slow, sorry.
That's exactly right. You'll be diluting the growth.
Betting
So-
on black, Mike. You're betting on
But this is the one time, guys, that I'm actually, more often than not, I really try not to get involved in conversations about indexing strategies with clients. Because more often than not, they're gonna get lost, right? The more they get lost, the more they don't wanna do it just because they don't wanna feel stupid. Well, all you can have this conversation very simply. You wanna bet the market's gonna go up, or do you wanna bet it's gonna go down?
Well, I don't know.
So what if we mix it up? And we go 50 on one side, 50 on the other. Does that seem like a fair bet, and we adjust next year?
Where do I sign?
Good deal. All right, so that's all I'm saying, guys. You've got some significant flexibility with this product that you don't have with other programs that we sell.
I have a question. So I have somebody that am waiting to catch the, thing, right?
Present,
Uh,
present. I don't like the word pitch.
present,
There you go.
present, whatever. Anyway, would it be a better idea to maybe, give her this option and that option?
I'm always a fan of options. Yes.
Cause that's what I'm thinking, maybe I need to have an illustration run on this too, since she delayed me another week.
You guys see what I wrote up here?
Yeah.
You're right at the 90. How many times you guys come in and said, oh, can I do something that's reasonable for an 83-year-old or an 85-year-old or an 88-year-old? The answer up to now is no, not really, no, not really, no. This is a fantastic product, and yeah, you can. Okay? If you flip it over, I don't really, like I said, I'm not really selling the LT Plus. You just notice if you put the caps and rates side by side, you're gonna see why I'm gonna probably shy away from the one with the bonus. I don't feel that 3% is worth the hack job that they do to the rates in order to do that.
Okay.
Yeah.
Are the commissions close to a fiend or a little lower?
You guys all have your comp grids. It's a little bit lower than a fiend, but they're still strong.
Yeah.
They're still strong. Troy.
So, on the classic mark, on this one, that's the 1 year S&P 500 point to point inversion, am I reading that right? It's 100% participation rate is 7%?
It means you get whatever the market does up to 7.
After 7.
Yep. If I showed you guys the Liberty Mark version, so this is the big brother of this particular product, that inversion strategy is capped at 15. Whoa. So let me tell you something else about this product that I think is really freaking amazing. You guys talk a lot about people that aren't healthy but maybe have some assets to play with. And we're looking for a way to figure out how to maximize their death benefit. Right? You guys ever run across that? Unhealthy, 3 bypasses, insulin diabetes, not a chance, and God knows where that you're gonna ever get them approved for anything. Well, we wanna help them boost the amount of money they leave to the family. Well, there's a death benefit rider on this product. It's also on the other one called the Liberty Mark. Heritage Maximizer. The cost on this rider is really very reasonable. 0.3%, 30 basis points. There's no guaranteed roll-up on that rider. Mine has to live for 3 years before it's going to do its job. But guess what it does if they make it past the 1,095th day? At that point, anytime thereafter, it's going to add 30% of the accumulated value of the product as a form of death benefit. So if you had a client that put money in, $100,000, they lived for 3 years and 1 day, and they had this on there, their family would get $130,000 with no growth. 100 grand, 3 years of down market, and we didn't use the inversion strategy. Die on the 1,096th day, 130 grand's going to the family. That's up to age 75. You can write that up to age 75. Even though the product goes to 90, the maximizer's up to 75.
Is there a minimum investment in that product?
I'm sure there is, and I apologize that I didn't pull that to tell you that. I think it might be about 10 grand. So.
If they die in the first 3 years, would that rider be refunded?
I need to look into that as well, I'm sorry. Like I said, I just started working with this product. I wanted you guys to see it, know it, at least know it's there. But nobody's talking about it. And I think it's really fantastic. I mean, Jim, Eric, and I just got a $257,000 version of this product issued. Guy was super happy. I'm about to get another 229 done with it. It's a really easy story to tell. Like I said, if you don't have a whole lot of moving parts and you have good rates, nice illustration, slide it over. Does that look good to you? Okay.
So, they live 3 years
And a day.
and 1 day, they get a 30% bonus.
So whatever the account value has grown to at that point.
So,
So when they pass away, whatever the account value is, plus 30%.
correct. turns into 130, 200 turns into 260, and so on.
No moving parts.
Don't have to explain roll-ups, don't have to explain anything. If you're willing to pay 0.3% of your total account balance, and you think you got at least 3 years left on this planet,
What does happen when you withdraw? It just decreases your,
doesn't matter at all, decreases the accumulated value dollar for dollar, still gonna add 30% to whatever's there at the end.
What's the six years?
Game on.
60%.
They're adding 30% to whatever. Because this product's designed for accumulation, the whole thought process is, we're gonna put money in, it's gonna grow well, and then we get to add 30% on whatever that number is.
Okay, but one minute, I got confused. The 30% is not just on the initial investment, it's also on the growth too.
whatever
It's
it's
on the
growing to.
accumulated value at time of
Okay,
death.
Okay.
So if I put in 100, Robin, and it grows to 150, my beneficiary is getting paid 195.
Okay.
Very cool.
Good?
You said this was the big brother to the Liberty Mark. What's the
It's
difference?
the little
between-
brother.
Little brother.
Yeah.
What's the
Little
difference?
brother
between
to who?
The other product that they have is called the Liberty Mark.
Yeah.
This one's called the Classic Mark. The Liberty Mark has significantly higher rates, but it also has an asset fee, which you're gonna have fun working your way around. It's got a 1.7% asset fee. So if you wanna have the conversation with your client and explain why they're paying 1.7% of their accumulated value each year to own that product, go right ahead. If you'd rather have a simpler story to tell, there you go. The rates are gangbusters, I'm telling you, but that 1.7 starts putting us in the realm of VA when it comes to fees. And we talk a lot about getting people away from VAs because of the ridiculous fee structures. So I didn't want to start with that one. If you guys want to hear more about it, I'm happy to tell you about it, but it's basically the same thing. Higher rates, 1.7% asset. Thank you for bringing that up. They can actually draw money out of this within 30 days.
Stop, rewind.
10%.
Oh, say that again?
They have the ability to withdraw funds within 30 days after issue. So, open the account. 30 days go by, you can start taking your 10% penalty freeze. Doesn't really do anything because they're just getting their money back, right? But people always get freaked out about when they can access money. And this one's a 30-day timeline. Yeah.
Minimum investment.
Fred was asking that, and I'm sorry I don't have it straight off the top of my head. I'm guessing probably 10,000.
No living benefit riders?
There is no income rider.
That's the death benefit rider.
That's the death benefit rider. This product is for death benefit and accumulation. Easy peasy lemon squeezy. Yeah.
If they don't do the heritage maximizer, if they die, then we still get.
Full accumulated value. I mean, basically, if you don't put the maximizer on there, it's just a no fee accumulation fixed index annuity. Simple, period, point blank. Like I said, no moving parts. Like I said, we're looking for products that the story's easy to tell. I'm looking for products that I haven't heard a lot of people talking about. And I've come to several of you and said, hey, have you guys checked out the Classic Mark? Yeah, I think you ought to be paying attention to it. It's a pretty strong story. It should be pretty easy to tell. You know, we've got a lot of other annuities that have a lot of different things that happen where we start losing people at the kitchen table. I don't think there's a whole lot to lose here. Any other questions?
How much was the Heritage Maximizer? How much does that cost you, basis point?
0.3%.
That's the cost for the rider.
It's the cost. So 0.3 buys you 30.
30 basis points.
30 basis points buys you 30% on your accumulated value extra at that. Minimum of 10,000. That was a good guess. Thank you, Jane.
You will.
Any other questions? Like I said, I just wanted to get up here and make sure you guys saw this thing. So, that being said, thank you for your time. Maddie, the floor is yours.
Give me a reason. Introduce them.
life insurance 101, but apparently there's a lot of questions about it anyway. So if you guys already have these, or if you've seen these before, just make sure somebody that hasn't seen these before gets it, okay? I only printed out 15, I might be yelling.
We have not seen it.
John's gonna email it out after the meeting as well, right, John?
Thank God.
I'll take one.
All right. We need some guests. Guys, it's gonna be short and sweet. Guys, real quick, this is a lot of basic stuff for the veteran agents. You guys already know this before, or you guys already know this. But there's been a lot of issues with UL specifically. I don't know if Mike wants me to say this, but I'm gonna say it so you guys aren't shocked. North American is almost dropped ASB's contract because we write such bad business. As a whole, what is it, 35%?
Not us individually, but as a whole,
ASB as a whole issued 35% of its business last year. So if you have pending cases, and I've got 5 large ones, we're actually being charged a fee, just so you're aware of it, when they get issued based off of premium. Kind of like Genworth and the other ones, it's based off of the size of the policy, okay? I'm telling you guys this ahead of time. I don't mean to dampen the meeting, but I'd rather have you know ahead of time before it actually hits.
that's why we brought in, what's that other company you brought in?
American National.
American National.
Their
Don't
contracts,
don't write North American unless you have to, because they're gonna charge you up to $400.
too.
$200, excuse me, thank you. It's $400 for me.
And believe me, guys, I got it on all 5 of these cases, so.
Because of the issue rate, they lost money on a block of business, because they have to pay, underwriters, they have to pay for the the
Paramedics,
nurses,
medical
paramedics,
records.
all this stuff, and
If you
they're
guys
sending
saw
people
some
out.
of the cases that got declined, it's embarrassing. I mean, these people can't even get an Omaha final expense, and people, not saying us, are writing these UL. So again, I don't mean to be the bearer of bad news, but at least you know before these things hit. American National comp rates are not showing the same as North American, but they are the same. Is that
If
right?
you do their life contract,
If you do their life contract.
which is a paper contract.
I think the numbers would have been higher if we would have been able to talk to underwriting.
I agree.
The exact other thing I told you.
Yeah, it's not set up right, that's
You
not.
would not have been on the call, but I was part of the call that they rolled this out and said we're gonna have to do this. I went off. I said, well, number one, y'all dampen our business the way we do business. If I can't call the underwriter, it's an issue. So again, there might be a place for North American here and there, but right now I think we need to write the other company because it's just a lot easier to do business with.
So you guys, again, you guys have been told before, like, don't write it. Now you have a reason why not to write it. I'm still gonna write them once in a while if they come back really inexpensive and I look at the whole picture of things. You know, sometimes it still works out. But so life insurance 101. If you guys have this cheat sheet in front of you, I'm just gonna breeze over a lot of this stuff and then I'm gonna sink into some of the more advanced things. When you guys run across it, if you run across, and there's some new faces in the group here, and you have somebody say, I got my life insurance through the bank, and it's $100,000 and it cost me $7 a month. It should be flashing high beams at you. It's probably an accidental death and dismemberment, okay? What that means is, unless they die because of an actual accident, that policy will not pay out. Well, what do you mean? 99% of those policies do not pay out. That's why it's so amazing when you see it on a piece of paper. You're never gonna get $100 grand whole life for that kind of premium. So again, I'm not gonna go over too much detail, but when you hear about somebody who bought it through their bank, the majority of the time, it's accidental death and dismemberment.
I actually was at a client's house and I read the policy, and basically it's set up, if I get in a car accident and they take me to the hospital and I die 2 hours later, I didn't die at the scene of the accident. I died in the hospital, so they're not.
Yeah, you have that at the accident. If you have a heart attack and you cause yourself to have an accident, it's still not accidental death.
Right.
Okay? Again, we're gonna breeze right over that, just so you guys are aware, but this is important. We don't sell a lot of accidental death, but you need to be aware of it, because sometimes people think they've got whole life and it's amazing, and if you're new, be like, wow, $100 grand a month for $7, I went through my quoting software, that's a pretty good price. Obviously, it's not. You gotta compare apples to apples. Term is designed for someone like myself. I'm 35 years old. I'm the breadwinner in the household. I have a wife and 2 little girls. And if something happened to me, if I was going to spend $50 a month on a whole life, I might get $100 grand at my age, prefer. That's not going to do anything for my wife on the long haul. she's good looking, she'll find someone else pretty quickly. But I wanna make sure she's taken care of. That same $50 a month buys me $1 million of term. So term is designed for people, and it doesn't matter specifically about age, but it's really geared towards younger folks. But make sure you're doing the right thing. We talk to people who are retired, and term is not right for them. Their policies are exploding right now, but term is not bad across the board. It's actually really strong for certain people. So just be aware when you're talking about term, it's not an automatic bad thing. It's based off of what they need it for.
They need to always have some form of permanent there. If you're above 65, you need to have some portion that you need as permanent insurance. If you're trying to cover a mortgage or different things, that's where you can add a term policy to it a little more less expensive that can handle that kind of stuff.
So you can do, there's different options on it. You can do return of premium that people have on term. I know Jim did a lot of that back in his former days. You can do convertibility options. I have that on my policy. I have mine with Transamerica. At the end of my 30-year term, when I'm 65, I have an option to convert that internally, regardless of what my health is like. With all the popcorn and pretzels and stuff we're eating here, probably diabetes and all that stuff. But anyways, I can automatically convert it over. I can automatically convert it over when I'm at the end of that term with no underwriting. So it's nice to have those different things on there. It's important for us to be aware, because if someone's in very terrible health and they're a good client of yours, and they are 65 and their term is ending, it's not a good thing to go and write them a Gerber for 10 grand if you can convert their term policy with them without going through underwriting. Okay? We're here to do the right thing for the client every single time. Don't just go there to sell them a graded policy because they had a stroke a year ago when they can convert it internally. Yes, ma'am?
Do they base the rate at the time of the conversion?
Yes. But typically you can actually reduce the face amount. So my $1 million term, I can reduce all the way down to whatever the lowest point is of
If they get their healthy underwriting class, they keep that.
Okay, I want to talk about term because it's very important. Again, just like when you hear about those policies taken out through the bank, be aware of the AARP New York Life. When I say that, when you hear people say, oh, I got my policy through New York Life or AARP, AARP, as we know, is not an insurance company, it's a marketing group. They do United Healthcare, they do New York Life for their life insurance. You're going to run across a lot of people when they say that, say, did you happen to take it out through the mail? Well, actually, yeah, I did. The majority of the time, it's term policies. And with those terms, it kind of looks like an index annuity, I guess, but it basically starts off at a certain level, and then at a 5-year mark, 65, 70, 75, all the way up, at the end of that 5 years, it goes up. Then that goes for 5 years, then it goes up, and then that goes for 5 years. When they turn 80 years old, what happens? They're going to get a phone call saying, would you like to convert that to a whole life policy at this point? Well, how much is it? $287. Cancel. It's only 10 grand. I can't afford it. So they drop their policy. Okay? If you run across one of these, you can actually call that same company, and they will tell you what the rate increases are at each one of those phases, and they can transfer you and say, well, how much is the same 10,000 if they converted it right now? Okay? It's kind of a bold move, but you want to do that because now you're comparing apples to apples. I have 10 grand, it's 26 bucks a month. I can't compete with that with a whole life, right? But what about when you look at this thing 4 years from now and it has that rate increase and now it's more? When you talk to them, when you talk to them in the whole life department, they're going to give you a whole life quote that we can compare to all of them when we smoke those rates, okay? You do not want to compare a term to a whole life because you're going to lose every time, okay? Just like the accidental death, it's two different policies completely. If you run across those terms, make sure you ask those questions there for you.
All right, so the question is, at that conversion point, let's say the guy's 75 years old, he's got a term policy, and they want to convert it to a whole life. Is that going to be the same rate as another guy with the exact same risk level coming off the street and saying, I want a whole life policy, I'm 75 years old? In other words, does the company give the term client a better deal, or is it market value?
The one thing you're going to lock in at is your health and the rating that you've got.
It depends. So you're talking about an agent that, so let's say they have it with, New York Life, and New York Life has a conversion privilege.
Right.
So you are going to convert that, you can have them go ahead and convert that and save that money, because you're not going to be able to sell them that. You don't have New York Life. But if it's a company you have, yes, you can have the same rate, but somebody else can't come in off the street and quote them at their current health situation and do it by no means. You follow what I'm saying?
But
No,
the rate,
no.
but what he's talking about, the rates are gonna be pretty similar. They're gonna give you.
What
the
I'm
current
trying
rate
to
for a
say is,
75-year-old.
the company that has the client with the term life, are they gonna give him a better deal than they would
So if
another
you-
company
Not
coming off,
You're saying
another guy
you
coming off the street?
Converted to Transamerica,
Gonna be the
someone
same.
else is 75, did convert.
All right.
75-year-old coming in, same price as the.
All right, so we can come up with another company and say, okay, we can beat it, go with us.
Just like that case we're talking about.
Right.
What's nice
That's why
about
I'm
that
As long
is
as
if
it's
they're healthy,
unhealthy, you can't do that.
that's
Right,
that case we
right.
talked about earlier, he was in good health, so that's a good, head-to-head comparison. If that guy had a heart attack a few years ago, and he might get a standard or a table 2 or something else,
Right.
you wanna keep the underwriting, not just the general cost of insurance, but that underwriting quote that he got 30 years ago or 20 years ago is gonna carry on to the next.
Okay.
That's the big difference. Jeremy?
Yeah, am I correct in saying that there is another AARP policy that's an ordinary level whole life?
Yes, yep.
Okay.
You knew that. Thanks for mentioning it, Doug. Appreciate it. So it's not just standardized like any of it. It's just an insurance company. Be on the lookout. You may give them a phone call and say, and again, I've drawn out that stair-stepping approach that they have just to get them interested. I thought you were from Medicare. I don't want to talk about this stuff. What do what's the whole point of this? Let me show you what I've run across with my own mother. She didn't have it, but she got a brochure. Is this any good? No, Ma, I wrote you life insurance, right? So, is this any good? No, but you draw these kind of things. This is where you get those people, instead of saying, hey, what can I sell you? What can I do? Give them a reason to. You got the AARP? Let me just make sure it's not one of these carriers. Norman calls insurance companies all the time. You get them on the phone, all of them. You get them on the horn and you say, oh, it actually is a whole life already. They just converted it 2 years ago. Well, come to find out, you can actually save them $15 a month and get them $300 back in cash value. So all you want to do is, when you're on the phone booking appointments, just get in front of people. Get them on the phone with the insurance company. You just want to get a hold. Because they said it was $10,000 in term. It's not. It's actually $5,000 in whole life, and it's all different. So get them on the phone to find out what they have. But there is whole life as well.
Talk about Primerica stepping up like that too, or I can.
Same thing.
Primerica's the same thing. They don't have whole life, so they can't convert that to anything. And when you're going to see term policies to be the same rate all the way through, at the end of those 20 years, the policy just drops. Or they have a huge rate increase, which is going to make them drop it anyways. Okay?
They just
But,
send their-
The big message is send from time, you get that policy out, call the
That's
policy in front of the client, the person on the phone's gonna sell it for you. Oh no, that's gonna grow up. Oh no, that runs out. Oh no, that cancels this point. They're gonna tell you the things, you just gotta know the questions to ask. That's what he's talking about. But you do that.
That goes into our next sheet.
And people that have Primerica and New York Life have no idea that they're in for what they're in for. They think they have whole life insurance, they think they're all good, we're all set, I don't need to talk to you about this, get out of my house, and their attitude. And you've gotta say that, well, wait a minute, let me just show you this real quick, like you did.
I did this in Myrtle Beach to a client. The guy's like, I'm all set. I've known the agent for years. And I said, that's fine. I trust you, Mr. Harvey. I get it. I'm going to leave here. Do yourself a favor. I know you know where your policy is. Open it up to the back page. It'll show you all the same rates for 20 years in a row. And then it's going to have another number when you're 72 years old. Give me a call back when you find it and let me know what that is. He called me back a half an hour later while I was driving to my next appointment and said, when can you come back and see me? It's exactly what you're talking about. Know what you're talking about. Be confident with these. Don't just be a server and say, oh, would you like to buy a policy? Get good at what we do and really dig in there deep. Call the companies, find out what's going on. When you call the companies, there's a needs analysis, a needs summary sheet, a life summary sheet inside of here. These are some of the basic questions to ask. Mike doesn't want me printed out 100 pages of this, but use this as a template if you want to keep these. I have a couple in my book. This is not designed for just one carrier, but if you've got 20 different policies in some of these houses, it's nice to list them obviously all out here. Husband on the top, kids, whatever else you have. You get the company name. Well, before this even happens, Mike said get their policies out. How many people say, I don't know where my policy is, or I do know where it is, but I don't like you enough or trust you enough to go get it while you're in my house with, all you need to know is the company name. I stopped asking for policies now. So when it comes down to it, oh, I've actually got an old Prudential policy. Great. Jordan, get on the phone real quick and give him a phone call, see what's going on. We get right on the phone and we call him up and find out what's going on with it ahead of time. We ask him the company name. We already have that. The type of policy that it is, the issue date, policy number, death benefit, cash value, surrender value. If it's a term policy, we don't ask about cash value. Those don't build cash, it's renting a policy. At the end of that rental term, it's done. Whole life, universal life, those build cash values.
Still sometimes a good question to ask on the phone in front of a client, because they might think they have a policy that earns cash value.
That's a good point.
Plus you wanna find out, has return of premium rider on there, you gotta,
Yep.
there's things you.
Yep.
That's
Talk about
loans.
loans. How many times you make a phone call and be like, oh yeah, they borrowed against this 6 years ago, never paid it back.
Or they didn't borrow against it, they didn't pay it for 3 months, and they took the cash value and used it to cover the premiums, and then charged it back to them as a loan.
That, we run across that a lot, especially with final expense. They had an overdraft thing happen in their bank, and they missed a payment, and they finally got called back up 3 months later, but they didn't pay back those 3 months of premium. It's exactly what he said. A lot of those have an overloan protection. If they miss a payment, they use the cash value to pay for it, it's a loan. Excuse me, it's like cancer in the body, and it just spreads. That credit card, if you swipe a credit card and you don't make a minimum payment on it, that thing just balloons up over the years, and it reduces their death benefit at the same time. Ask about loans, even if they said I've never borrowed against it, and look at their face when they say you do have a loan for $287.
You also might want to ask, instead of a loan, because they're thinking, okay, if I taken a loan, did I get money? Say, okay, well, did you miss a payment?
This is the actual company, so again, you say, are there any loans on it? No, there's none, and it just kind of helps solve it. If there is, be like, did you borrow against this? I certainly did not. Looks at her husband, did you borrow against this? I didn't either, so obviously we must have missed a payment or something. But again, you're hearing this right from the horse's mouth the entire time. Do your due diligence. If there is a loan in the policy, just like with the term, don't just quote them based on, let's say there's a $1,000 loan on it. What's the interest rate? 8%. That's $80 a year in interest. That's $7 a month, right? Use that $7 a month as part of the comparison when you're doing your now and will be. That's very important, because you're not comparing apples to apples. You're comparing apples to oranges with a huge loan on it. That's going to reduce their death benefit a couple of grand, and it's charging them at least $80 a month, $80 a year just to have that loan there. How much more can you pay into this to get that loan paid back?
I sold a policy, every time somebody had a loan, I sold a policy. Because I would say, I'm gonna see if you qualify today for your loan cancellation program, because if I can get you qualified health-wise, I can cancel out that loan and give you a new policy today and save you money. That sounds like something that you might do, yeah, I mean, every time. Loan cancellation program.
Mike's more of a talker than I am. I'm not. This is a document server too, just come to my attention.
You asked,
Okay, one more thing. We're gonna get into some of this more detail.
you asked who the beneficiary is.
That's a good one. You can always verify beneficiaries as well. It's good to ask that question.
Because I run across 3 or 4 times a year talking to a spouse and their spouse has passed away and they have not changed the beneficiary. That gives you a good reason to service the account. Well, we'll call them up and we'll get a change of beneficiary form for you. Okay, great, do that.
All reasons to make those phone calls. If you're going through your presentation, your fact finding, and somebody says, oh, I don't want to mess with it, that's another great one. I've got to make a quick phone call. You'd be amazed how many red flags I've seen with this. I've seen ex-wives as beneficiaries. The new wife's like, oh, really? So she's back in the picture. The ambient bubbles are out. Don't worry about it. You're fine. But again, it's just a matter of, one of these times I'm going to strike a chord and they'll be like, just joking. You say, well, no. There's more things in here. They talk about the premium. On the last column here, it got kind of Xeroxed out there, but it's the COI. We're going to get into that in a second. It's the cost of insurance. Okay? So that last column is cost of insurance. All these things here, if you're brand new and you don't even know what this stuff means, and you might ask for cash value to term because you forgot what we talked about, that's okay. When you come back to your manager and say, hey, listen, this is what they have, this is their medicines that they take, they can help come up with a game plan for you. Okay? So just try to get this all filled out the best that you can. I'm going to show you guys how I actually explain one form of permanent. You guys all know whole life, right? It's just set it and forget it. You pay your premiums, it builds cash value. I'm going to do what I call the bucket presentation. I don't mean to bore you guys with this stuff, but I've seen it millions of times. But the way that this actually works is I'm going to use this for a couple of different ways and explain the difference in 2 different types of, or 3 types of permanent life insurance. Let's say your death benefit's $100 grand. And your premium is $100 a month. Every single month you pay money into your bucket, right? There's little holes in the insurance, or the COI. Well, if you put $100 in and your cost of insurance is $80 every month, obviously you're building $20 in your cash value each month. The big difference between a whole life policy and universal life is this cost of insurance. If you have a whole life policy, this cost of insurance is fixed. The premium is fixed, the death benefit is fixed, and the cash value growth inside of here is also fixed. So that way when you look at Delivering in America or Royal Neighbors in that back page, you know that in 17 years, cash value will be worth 24 grand. It's very plain vanilla. Okay, well how is it different than a universal life? Everything stays exactly the same, but every time you make a payment in here, your cost of insurance goes up as you get older. So right now it's $80, next year it might be $81.20, and it keeps going up based off of your new age. Okay? Does everyone understand that first part? That's very important, cost of insurance. When you talk about the cash value inside of a universal life policy, it's similar to an indexed annuity like Dave just talked about. The cash value inside of them can make money without losing, but it's not a guaranteed rate. They have guaranteed and non-guaranteed. Okay? Not to lose anybody here, but the reason why we ask about these is because if you have old policies and let's say they assume an 8% growth rate back in 1988 and it didn't do 8% growth, their cash value actually may start going back down. This is also known as flexible premium adjustable life. So they put $100 into this now. It's not $80 that's coming out because they've had it for 30 years. Their cost of insurance might be $120. And your cash value is 18 grand. $100 comes in, now you actually don't have enough. You're losing $20 a month in your cash value. Does that make sense? This is called an underfunded UL, or underfunded flexible premium adjustable life. When you run across these, their policy doesn't have the same guarantees like the guaranteed ULs that we do that last forever. So when you run across policies like this, just because it builds cash value doesn't mean it's a whole life, okay? But always make those phone calls. And when you ask about, if they say it's a universal life policy, that's when you ask about the cost of insurance. And if the cost of insurance is more than what they're paying, that means they're losing cash value every single month. I don't mean to be repetitive here, but I just want to make sure that's clear. It doesn't mean it's a terrible thing, because if they've got 18 grand and they're 88 years old and they're losing 20 bucks a month, they may never see this. It might be set to run till they're 98 years old and they're happy with it.
Eventually that's gonna happen no matter what, pretty much.
Exactly. So Matt, I thought we offer universal life. Isn't that what we do with North American, American National? Yes, but the difference is if your cash value ever hits zero, both your premium and your death benefit are locked in all the way through. Okay? So I have clients who say, Matt, I like my term, it's really, really cheap. Well, Matt, I like my whole life because it's permanent, it lasts forever. This is the guy right in the middle. It's not designed for a ton of cash value growth, but it gives you the same perks of having a whole life without being a whole life. Okay?
Borrowing.
No, not at all. The biggest reason why we use these is to leave behind a guaranteed death benefit and a guaranteed premium. You can overfund these and pay $500 a month and do larger type things if you're doing like investment growth. I'm telling you right now, we can do those. I'm not going to train on that because it's just, in 13 years, I've probably done 2 of them. Because most people aren't investing into overfunded ULs, although it is a strategy.
You said when asked about the cost of insurance, please note that Matt was talking about asking an insurance company. If you ask your client about the cost of insurance, they'll say, what in the world are you talking about? So you have to ask that question when you have their insurance company on board.
Okay? All right, so whole life, fixed, fixed, fixed. Universal life, these things can have moving parts. Guaranteed universal life, which we do the most of, these are guaranteed, and no matter what happens with your cash value, it lasts forever till 121, or whatever you guaranteed out to like 95. Okay? When you're talking about underwriting, whenever I do explanations, let's say somebody has a $20,000 whole life policy with Standard Life. I'll use your example. They've got $20,000 in whole life, and they're 65 years old. The guy just took it out because some agent that's who they work for. Oh, I took out a med sup and they took 20,000 their whole life, it's $120 a month. Do you have any health issues at all? No, why? You're in the wrong plan. There's 3 grades of life insurance that I offer for people, and it's all by your health. The one at the bottom is guaranteed issue, there's no medical questions, you can be bedridden in a nursing home, and they'll approve you. This has a 2-year waiting period, there are no medical questions, and it's designed for certain people, but if you die in a year, they do not pay out at all. Does everyone understand that? No matter what, if you go with a graded policy, guaranteed issue. Next one up is simplified issue. This is designed for people in mediocre health that want maybe a $10,000, $15,000 policy. If this guy's 65 years old, he's got 20 grand in here, and he's healthy, what's the price of a guaranteed UL in this category with a bigger death benefit? As long as he's healthy, he could probably get 25 grand for cheaper than what he's doing for 20. And the reason why is because these policies in the middle, they just pull MIBs and ask medical questions. This guy up here is medical records, blood and urine samples, but if you're okay with me orchestrating that for you, I can give you much better bang for the buck. Okay? Does that make sense? The problem we were running across before is that people that couldn't even get an Omaha final expense were being applied for universal life policies with all these expensive things that shouldn't even been, applied for. These top 2 categories here, I know this one definitely doesn't pay out in 2 years, but I do want to mention contestability. If they die in 2 years with these, the death benefit most likely will still be paid out, but they're going to try to, as much as they can, not to pay out that claim. Okay? So if somebody's kind of fishy with their underwriting, or if you see something in the house and you're like, oh boy, I think they're lying to me, don't just go and sell it for the heck of it, because if they die a year later and they do contest that, they can pull medical records and they may deny that claim. Okay? So.
What if they went through full underwriting and they died before that? I mean, they still.
I've never once had a universal life policy go through that contestability and get declined because they're so thorough on the front end. But I actually have. It was the worst feeling in the world. About 3 years into it, I had a policy right in the middle here, and she had an AARP term. I'm on the phone with my daughter at 8 o'clock at night, and she is screaming at me because the policy didn't pay out. The doctor had it on file. She had COPD. She didn't have COPD. I asked her, I said, I said, let me see why it was declined. It was from COPD. She said, my mom doesn't have that. And now she had to go after the doctor for putting those notes in the thing there. So it's a crummy feeling. Let me be the example for you. I did everything squeaky clean in my power, and it still came back as that. So I just want to make sure you're aware of it. Okay. There is a picture of the bucket presentation here on the last page. If you run across somebody with an underfunded UL or with an old whole life policy, that same example that we just used, standard life, let's say it was 20 years later, he's got 18 grand, and you just want to do more for him. There's 3 different options if you can do what's called a 1035 exchange. With this equity that's inside the policy that's grown to, if they're healthy, you can actually take this cash value and roll it into a new policy. This is called a 1035 exchange. It goes from life insurance to life insurance, and they don't pay taxes on it. If there is a loan of 3 grand, that could be a taxable amount because they've never paid it back. Okay, so just be aware of that. But you have 3 different options. If you do this and they're healthy right now, you can either get more life insurance if you wanted to for the same price, you can get a little bit of cash value back, or you can do a little bit of both. Okay? There is an example here. This is a lady I actually ran across. It was a, I want to make sure I address this as well. Leads suck. Lists suck. Leads suck. I hear it all the time. There's got to be better things. Got to be better things. This was the biggest life insurance case that I ever wrote. Okay? I wrote her husband. That was actually the second biggest. But this came from a drug plan lead. They mailed something in. I don't want to talk about anything. Can you help me with my medicines? I go to Hilton Head and I help them with this. When we're on the phones doing this, you're not going to know on the front end what their life insurance is, what kind of variable annuities that they have. Your job is to get in that door for any reason whatsoever. Okay? Even if it's doing a UNL for somebody who's 89 that has Alzheimer's that we know we can't do. And they're writing $200,000 annuity. So I'm just saying, it doesn't matter what the reason is for it. When I got out, the lady said, I got plenty of life insurance, I don't need any more, I'm all set. I drew a bucket presentation. I explained about how the old policies work. We can actually do this. Do you guys have a copy? Anyone has this? This is powerful. Her New York Life policy had an odd death benefit. And when you're making your phone calls into these companies and it has an odd death benefit, there's got to be a reason for it. Her death benefit was $338,400. Nobody says, hey, I need life insurance for an exact amount like that, so obviously something is going on. Her policy was saturated with cash value, and she's still paying a premium for it. So we're able to take that equity, roll it from New York Life into ING, which is now Voya, and we could actually do $425 in a paid-up policy. You guys, can everyone see that at the table? I know you guys have probably seen this before, the veterans, but that's powerful stuff. It's the equity inside of this policy, rolling it over into the new rates that they have now, and just getting a paid-up policy. And I know what you're thinking, Mark's like, how do those numbers work? She happened to be very young. She'd had that policy since they'd been married. And it kept building up inside of it. I want to use this not just for the numbers, but for the format. When you're doing these kind of things here, you're explaining in the presentation, your final thing should not be verbal, talking at them and saying, okay, so we can do this and save you $500, do this over here. Do a now and will be. This is something that I printed off from because it was a larger case, but anybody who's ever been on my team before has always seen me do now and will be's. I don't care if it's a med sup, annuities. I started doing it with annuities now. It works out great. I leave it behind. What you have now for fees and risk and income versus what we can do for you, these now and will be's are extremely powerful. These people are going to forget what you've talked about an hour later. If they go to this afterwards, they'll be like, wow, that just makes sense. That's a no-brainer. I stopped saying no-brainer because Randy told me not to, but my terminology now is flashing high beams. If this doesn't flash high beams at you, then don't do it. But to me, it's an obvious move. Does that make sense? So, life insurance, whole life, term, bucket presentation. It's not the full-blown bucket presentation. We can do that in separate training. I'm just trying to give you a quick overview. Questions?
Yeah. You ever do the before and after just on a piece of paper?
Always.
Leave it around.
I'll do in the back of the fact finder sometimes. Well, not fact finder. On a separate sheet of paper.
Okay, just like this. Not printed up or anything, just handwritten. Thank you.
And I told them that. I said, it's not fancy. I said, but I have so many people that go out there and leave you stacks of brochures and 30 pages of all this stuff. I said, I like to keep it simple and straightforward. You've got policy already. Do you want to leave more money behind to your kids, like in that one? Do you want to leave more money behind to your kids? Because if you do, and you're okay paying the same premium, I can take you from $338 to $650. Because those companies they don't love you, New York Life. They're not giving you any love. You locked into that 30 years ago. You're not going to change. They're not going to call you to change it. Going to the open market now, you might find some better rates. And like I said, you can do partial cash outs if you wanted to. There's lots of different options there. Yes.
I understand, and please forgive me, I'm a newbie, so please be patient.
Sure.
It
We'll
says,
let her in here.
okay, I understand the before, I understand options B, C, and D for the after, but I don't understand how you got option A for the after.
So option A, the reason why this is all possible, imagine if I was going to buy a house, right? I can either spend, let's say the house is $100,000, just for easy math, okay? I can either buy the house for $100,000, or I could finance it. I could put $50,000 down and make payments on it. This first option is saying, I'm going to give them, there was $100,000 of cash value inside of this policy that she had. So every time she made a payment, there were dividends accumulate inside of it. This policy was extremely saturated with cash. We're able to take $100,000, go to the open market, and ING came up as a really good quoted company. So we took $100,000 of cash, rolled it into the next policy for her. So she did make a large deposit into it, but it was off of the equity from her old one. So ING says, we don't need any more monthly premium for you as long as that $100,000 comes in as a lump sum. Does that make sense?
I think I got that.
There's something else,
For that $100,000,
Right.
she's also 60 years old. I mean, she was very young. That was a preferred. Big difference.
Matt, just a point here, so,
Yeah.
you looked at underfunded before, this is an overfunded policy.
No.
So as the policy gets more overfunded, it sort of gets inefficient, right? So we want an efficiency, that's what we're looking for here.
to be careful with overfunding, it's not overfunding.
Well, that's probably not a good word, but inefficient's probably a good word, right?
I know that inefficient would be a good word. I mean, it's just a matter of how, it's all about, life insurance can be anything you want it to be. It's a matter of how you design it, what you want out of it. I mean, I bought a policy on my son as soon as he was born. The cost of insurance, I did a $200,000 policy because I'm insuring his insurability. That's why I never collect on it. But I want to make sure, I didn't know what kind of health he would be later on in life, didn't know what happened, so I wanted to make sure he had life insurance for his family later on. But $5 a month was the premium for that. Well, I pay $100 a month into this thing. The cash value on it, by the time he graduates high school, is going to be pretty significant. So at that point, if he's healthy, as he is right now, he can take that cash value and do exactly what Matt's talking about. He can take that cash, roll into a annuity for him and his family, or he can cash it out and pay for school. He can do whatever he wants to. So it's a matter of what you want done with it.
Let's talk about cash value, okay, because this is important. A lot of people think cash value, that sounds good, like cash in my bank, right? This 18,000 on this 100, when you pass away and you leave this behind to your spouse, they're gonna get 100 grand. That 18,000 of equity that's inside the policy stays with the insurance company. If you go and you say, I wanna get my cash out of it, you're not gonna actually get it and get to keep it like you would out of your savings account. They're gonna give it to you in the form of a loan, okay? There's one option, it's called option B, and it's very seldom used because it's more expensive, but it would pay out a death benefit plus whatever cash value is inside of there, okay? So when you're talking about efficiency, this cash value is just sitting there. Instead of leaving it with the insurance company that nobody can use, let's maximize and leverage your dollars that you have. I know you love leverage. Leverage the dollars that you have now to make it as efficient as possible.
That was my
Let's
point.
leave this cash value down to zero. When you're 92 years, there's no more equity, but the price you pay and the death benefit are locked in forever. It's the safety
Unless you're like
mechanism.
Mike and you're trying to build up the cash value for utility down the
You're
road.
very seldom-
Exactly. And that's few and far between. Most people, especially the clients we're seeing at that age, are not looking for that.
Right.
But
You meet somebody in their 20s, 30s, that's got a new family, that's the concept all day long.
be on the lookout for a lot of clients that you meet with that have a $15,000, $20,000 policy that can actually qualify medically for a UL, because the numbers are drastically different and in a good way, okay? One last thing I want to mention, just as a sales concept, I just kind of thought about it. I've used this a couple of times now. Whenever you meet with people and they're on a fixed income and you see that they have a loan against their policy or something else, and you say, how you doing financially that's kind of tight, ask them what they have for credit card debt, okay? Let's say they had a policy that was only a $10,000 whole life from 18 years ago, and it's 10 grand death benefit, 2,000 in cash value. If I gave you 2 grand, Ms. Morris, right now, what would you do with it? Buy one.
Shopping problem.
If you say that to somebody, sometimes it's a big deal. I would actually be able to go to my daughter's wedding because she's actually having it, the plane tickets are too expensive, whatever. Ask them what they would do with that cash. If they've got credit card debt, again, compare that into it. I've got a $2,000 MasterCard, and it's at 28% interest. I'm never gonna pay that off. I'm on Medicaid, and I've got $700 a month coming in. Well, what if we do a credit card reduction or a credit reduction, use that cash, wipe out your credit card debt, now you just freed up a $100 payment that was otherwise going to a credit card company you'd never get rid of. So yeah, your life insurance may be $18 more than what we can do for you, but we just knocked out a $100 bill that's coming out of your checking account. So ask about credit cards. Every once in a while, it might help you get one extra sale a year. So
My advice to you is to become a student of the game of life insurance. There's so much you can do with life insurance, and it is such a profitable product that you can make. I mean, you can make really, really, really good money selling life insurance. And it does have renewals into it. It's not like health insurance renewals, but it's a good renewal.
when you do it now, Wilby's with this, it should be flashing high beams. I mean, every once in a while, you upsell them, you sell something that they didn't have already, but the majority of the time, it's like MedSubs, taking what they have and just making it better. Just like I did for this now in Wilby that we did.
Another newbie, sorry. But if you take them from something like that into a new one, don't they have to be you have to go through the underwriting? process?
Absolutely, yep, so you wanna make sure they're healthy to do so. Yep. To get this caliber life insurance of another thing too, the minimum is 25,000 and above. They're gonna have a nurse come out, do blood urine samples, look at medical records, and they don't have to be in perfect health, like maintenance medicines are fine. I got some arthritis, blood pressure, cholesterol, no problem. Diabetes in the pill, not an issue as long as everything else is under control.
Okay.
Even if you're looking at like heart attacks, strokes, cancers, those are more of the red flags. but yes, it will go through underwriting.
Okay.
I think sometimes people do e-apps on the universal life, and they see there's no medical questions on there. Those are asked by the nurse when they go and do the exam. So there are very hard medical questions, and they ask about family history and things like that. So just because you don't see it on the e-app, it's done by professionals at times. So they do it to be very, very healthy.
Automatic rule of thumb, and I'll get to your question in a second. Automatic rule of thumb, and I know this sounds very basic and simple, but if they can't get a simplified issue, because they have COPD or diabetes insulin, 100 units a day, I know it sounds silly, but then don't apply for guaranteed UL. I don't care how amazing the submitting commission is gonna look on your Friday report, it's not worth it. You're gonna lose faith, it's
What you can do, what I do is, if I do a UL, I'll ask the simplified issue questions. And then go through the questions and see how they answer that, and then I can gauge of how they're gonna apply for a UL, without wasting my time.
Ask your manager too. They've seen all the medicines out there. I mean, I know for SMI and all the rest of the ones you see that would knock people out. Oh, I take it for blood pressure. No, you don't. You take it for congestive heart failure because you have this issue going on here.
Why?
So we've gone from a UL down to a guaranteed issue.
I like that, I got a little bit of sugar.
And how much does family history play as far as?
Family history plays a role only with super preferred categories. Okay?
Okay.
If you're
Standard
doing
issue doesn't matter.
standard issue, preferred, and super preferred. And again, I know people, I hate North American because they're terrible. North American, Jordan, I just had a 74-year-old, super preferred non-tobacco guy, lives up in Pawleys Island. And the guy's like 6'3", like 220, like he's not some tiny guy. They'll give the rates that they actually deserve. They have an app for you at the end, which picture that.